Okay, before we head into this week's market outlook, for level 3 candidates that have multiple did not passes, multiple DNPs, I said I would be doing a 6-week live seminar series, 6 sessions over 6 weeks to sort of help out there. You can now sign up for the L3 live seminars if you are a subscriber on our site and you've had at least one did not pass with us. I mean, if you've had 3 did not passes but you've had it with somebody else, you can still sign up, but there's only limited space. I can only handle so many people in these seminars. I don't know how many sessions I'll need to have, but priority will be given in order of you did not pass with us and the most number of did not passes and the most with us on downwards. So, I don't know what the demand for this is yet, but you can click on that and you can sign up. It gives me an idea of how many people, what the demand for the seminar is, and you get to pick 3 different time periods under which you can attend, so that I can then see where the demand is to make sure that I have the sessions are running enough sessions overlapping with the times that are needed. Also for the market outlook next Sunday, May the 14th, I will be doing a live YouTube Q&A. And that is at 6 p.m. I find that when I do the market outlook, there's so much to say. I make my notes during the week and I look at everything that I have and I think there's no way I can do this in an hour and a half. This is 2, 3, 4 hours. It would take me way too long to get done. So there's a lot of stuff I simply just leave out that I find that when people ask me questions, it covers all of those topics of which I've made notes on during the course of the week. So it might be worth it to have the very standardized market outlook that I do, which is very macro top down, and then handle all the other stuff in a Q&A at 6 p.m. So on May the 14th, next Sunday, May the 14th, at 6 p.m., I'll do another live YouTube feed where you can ask me whatever questions you have, and if I have the information that I can answer, I will answer them. Well, let's begin. Let's begin with the FOMC meeting on Wednesday. We'll look at the press release, and then we'll go through the press conference. Some interesting questions and answers. The FOMC raised rates 25 basis points at this meeting, and out of the statement, a sentence was removed which said the committee anticipates that ongoing rate hikes are going to be appropriate. That's now gone. So this is seen as a pause. However, when going through the press conference, we can see that it is a pause with a very stern warning that if inflation shows up again, we're moving. Bank of Canada did that this week. They held rates steady at the last meeting. And during a Q&A period this week, Tiff Macklem said, yeah, it's fully appropriate for us to raise rates again. This is in response to seeing a very tight job market, wage pressure increasing, and housing prices rebounding. In Toronto, I think it's now 3 months in a row where housing prices have gone up. The average home price is now over $1.15 million. So this is starting to come back in. Let's see what the FOMC said here. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Well, we haven't seen it on hiring, that's for sure. We'll look at the jobs report that we got on Friday for the month of April. And you had a whole month of April. These banking issues happened in March, and April still came out very strong, above expectations. And we'll look at the mix of jobs that were created. It doesn't look like there was an effect on hiring. May 8th, we get the Senior Loan Officer Opinion Survey. It comes out quarterly. Usually doesn't get much attention, but it's got headline status this month. In the press conference, Powell sort of gave away what we can expect in the sluice, so we'll see what his comment there was. Committee decided to raise the target range for the federal funds rate to 5 and 5.25. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We keep hearing about these long and variable lags. Well, it's been a long time since they've raised rates. We're 10 straight meetings. We're a year now that they've been increasing rates. At least 6 months of elevated rates, and this is where we are. It doesn't seem to be affecting employment very much. We've seen inflation in wages and prices tick up. If you look at the PMIs from the last week, prices paid on both manufacturing and services went up. We look at average hourly earnings this week. It went up, but again, that's sensitive to the mix of employees, and we'll have a look at the mix. The ECI, the Employment Cost Index, went up, and it was noted in that report that the acceleration really was in March, that we saw an acceleration in March. So when are these long and variable lags going to kick in? And I would argue that perhaps the neutral rate is not 2.5%. Perhaps the neutral rate is 5.5%. Maybe the neutral rate is 6%. But if we're sitting at 5.25%, and we're not seeing much of an effect on employment at all, then you can't argue the neutral rate is 300 basis points lower. This has got to be the new neutral rate. What else we got here? The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goal. You can read that two ways, because the committee has two goals. If inflation reemerges, then they're prepared to adjust the stance of monetary policy tighter. But full employment is also their mandate. So if that becomes a threat, this sentence could be read as we're prepared to adjust the stance as appropriate. So if we see unemployment increase significantly, they're prepared to cut rates. And so the sentence can be read in two ways. Let's look at that press conference. Okay, opening remarks. He's trying to get two things done here. He's trying to put the banking issues in the background and bring to the foreground the dual mandate of the Fed, and within that dual mandate, elevate the importance of inflation. A banking system sound and resilient, period. Forget about it. Nothing to see here. Focus is squarely on the dual mandate. We understand that the hardship that inflation is causing. Remain committed to bringing inflation back down to the 2% target. Price stability is critical. We're going to have a data-dependent approach regarding future actions. On the economy has slowed significantly. We saw real GDP in the first quarter come in at 1.1%. Pretty much saved by the consumer. Business fixed investment pretty much brought that negative by, 2.8%. Housing sector activity is weak. Tell the home builders that, right? Business fixed investment. I typed that in wrong. Business fixed investment is weak. True. Labor market is tight. Unemployment very low. Some progress, but overall labor demand is greater than supply. Lowest unemployment rate since 1969. Inflation has moderated, but inflationary pressures continue to run high. And he said we have a long way to go. Economy likely to face headwinds from tightening credit conditions, and these pressures have increased since March. So their thinking is that, look, some of this, the tightening of credit conditions, is probably going to do some of the work for us. We don't really need to raise rates to that point. The other thinking is, and my thinking along these lines is, if credit standards are going to tighten anyways, raising rates isn't going to change anything. If I can't get a loan at 5.25, I can't get a loan at 5.5. It's not as if it goes to a higher level, then I would be disqualified. If credit standards are going to be tightened, there is a hole in there anyways. If it acts like a rate hike, why not just fill it with a rate hike and really send inflation a message, right? But future decisions will be meeting by meeting, prepared to do more if warranted. Okay, always leading off, New York Times. Are you going to pause in June? And has the staff revised their recession forecasts? Because you'll recall with the last meeting, the staff had forecasted a mild recession later this year. The answer, decision on pause was not made today. Ongoing rate hikes was removed from the statement. And I do not share the staff forecast. I expect positive growth. Staff forecasts today broadly similar to the last forecast. We won't see the staff forecast until we get the minutes in 3 weeks, and then we'll see what the staff forecast was. But it said broadly similar to the last forecast. Washington Post: what is the economic effect of default? And we knew this would happen. No comment. It's fiscal policy, no comment, which I find odd because the Senate seems to have no problem commenting on monetary policy. I think tit for tat. He should comment on fiscal policy. This is a kind of an important statement, but no one should assume the Fed can protect the economy in the event of a default. The debt ceiling debate did not affect our decision today. CNBC, and this was rather, I wouldn't call it a tense exchange, even though it's being described as it. What effect did SVB have in the meeting on February 14th? Because in that meeting, they had some information about some banks that were in trouble, and there was a one-page report, just an informational thing, as Powell called it, on SVB. So they were aware at the time, on February 14th, that there were growing issues. It was just an informational presentation, one page on SVB, not urgent or alarming. Monetary tools and financial stability are not in conflict with each other, so that we can support financial stability without sacrificing our dual mandate. They are not in conflict. And Christine Lagarde says the same thing from the ECB. She does not see these things as being in conflict with each other. And then Steve Leisman gave some pushback. Why was the presentation not alarming? It said banks with large unrealized losses face significant soundness and safety risk. And Powell answered by saying, I did not say it was not alarming. But he did. If you review that press conference and listen to the first answer he gave, he says it wasn't urgent or alarming. And he said, how can you say it's not alarming when it said these words? Like, what are you thinking? And he said, I didn't say it wasn't alarming, but you did, kinda, right? Financial Times, credit tightening, still seen as 1 to 2 rate hikes. Impossible to estimate, but we won't have to raise rates as high if this did not happen. So they must be seeing some extra credit tightening as a result of this. Remember, they already had a peek at the Sluice report that we won't see till May 8th, but there is a question on it down here. Follow-up question, pause as early as next month, and he's not committing to that. It's a meeting-by-meeting assessment. Reuters, are you sufficiently restrictive? Ongoing assessment. It's not possible to say with confidence that we have reached that point. We are at the SEP levels on rates, and in the SEP, they had end-of-year median Fed funds rate at 5.1%, which they're there now. We will revisit that in the June meeting. We get an SEP every second meeting, and we didn't get one this meeting, so June 14th, we get a new SEP. What did Sluice indicate? We're going to release it May 8th, but it was broadly consistent with other sources, Beige Book and earnings calls that you had heard from some of the regional and national banks. Broadly consistent with other sources. So sort of giving something away here, but we don't have to raise rates as high as if this did not happen. So on net, there must have been a resultant extra tightening of credit incremental to where rates are because of this event. Why was it necessary to raise rates? Why not wait to see the effects? This is the Wall Street Journal. We're trying to reach sufficiently restrictive territory. The assessment will be ongoing. We have seen inflation go down, go back up 2 to 3 times since last March. Policy is tight. Take nominal rate and subtract 3% average one-year inflation, real rate of 2%. So he's trying to make the case that real rates on the Fed, if you look at the Fed funds rate, real rates are positive. So that is restrictive already, but he's not really committing to saying it's sufficiently restrictive. Subtract 3% average one-year inflation. When I was watching, because I have two screens, one is Mr. Powell. There he is talking, blah, blah, blah. And the other screen is a chart of the S&P 500. And when he said that 3%, it just, nice green, it started printing green bars. Wondering where you get the 3%. If you look in the summary of economic projections, year end has 3%. Fox Business, 3% at end of year in the SEP. Is a prolonged 3% okay? Answer, 2% is the target. Not looking at 3%, then stopping. Labor market is extraordinarily tight, 50-year low in unemployment. Wage growth a couple of percentage points above what would be consistent with 2% inflation. So 3% is not our bus stop. 2% is our bus stop, period. Bloomberg, why are you optimistic that a recession can be avoided? This was a really interesting answer, and he even pointed out in his answer how rare it would be. Rates are up 500 basis points and unemployment is at 3.5%. This time really may be different. There's so much excess demand in labor markets. It's possible to have a cooling of labor markets without an increase in unemployment. And then he says, I admit this goes against history. It would be the first time it's ever happened. This is the position he has. I have a forecast of unemployment increasing without causing any damage. It's never ever happened before, but we think we can do it now. Wage inflation must be closer to 3%. I don't think wages are the principal driver of inflation, but he did not say what was the principal driver of inflation, but he's focused on wages. You say up here, wage growth a couple percentage points above would be consistent at 2%. You can have a cooling of the labor market without an increase in unemployment. It must be closer to 3%. I don't think it's a problem. There's so much inconsistency in the answers to those two questions. I wonder if he even, in his mind, has clear what the effects, what the causes and effects are, because I'm beginning to question his ability here, because these two answers just seem to be inconsistent with each other. Are expanded profit margins a driver of inflation? Higher margins are a result of demand being greater than supply. Well, that makes sense. If demand is greater than supply, I don't have to cut my price. I can raise my price and I'll still be able to sell all that I can make. Welcome to the auto industry for much of 2022, right? As inflation drops, margins should also drop as demand comes into balance with supply. So if inflation does drop and margins do drop, that means the profitability per dollar of revenue would drop because, well, lower levels of inflation mean, well, you're not raising your prices as much. So that does not sound like a good forecast for equity prices. Okay, Bloomberg again, this time Mike McKee. Are you looking at backward data? Are you forecasting? Are you ruling out rate cuts the market has priced in? Three good questions. We're looking at a combination of data and forecasts with a particular focus on credit conditions. Inflation is going to come down not so quickly, which is an odd sentence. Inflation is going to come down not so quickly. I think he thought about a sentence midway through and then didn't want to give any kind of a hope to the markets here. Inflation is going to come down not so quickly. It is going to take some time, so no rate cuts. Non-housing services really hasn't moved much. Axios, the reverse repo, contributing to stress by making it easier for money market mutual funds to compete for deposits? No. Deposit flows have stabilized for now. Another kind of question mark on that one is, what are you looking at? Deposit flows have stabilized for now. When we look at the flows into mutual funds shortly, we'll see that it was up by another $53 billion. Well, this money has to come from somewhere. CBS News, impact of default must be avoided. Fed can't protect the economy from damages. NPR, blah, 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 who cares? M&I Market News. Are we in the earlier end stages of the banking crisis? Is the bias towards higher rates? And his answer is, look, we're talking about 3 banks only. They're all resolved. FRC draws a line under severe stress. All over. Nothing to see here. Let's move on. Barron's, discussion of pausing at this meeting. Support for 25 basis points was very strong across the board. Pause was discussed, but not for this meeting. Is the bar higher for a rate hike now? We're going to be meeting by meeting, giving no forecast to that at all. Okay, let's look at rates. And the story from last week was the 1 month. The story this week is the 1 month again. 5.59. It ended on Friday. 5.76 was Thursday. And the Fed funds range is 5 to 5.25. You remember a couple of weeks ago it was down to 3.36. This thing sounds like it's a meme stock on Wall Street Bets. It's just the way it moves around. But increase of 124 basis points to 5.59, I have no explanation for the drop in price on the 1 month that now has it yielding 5.59. I've got no explanation for that at all. The closest that I can get to is that with the X date estimated at June 1st, and we're sitting at May 7th right now, that it is possible, given the level of clownishness that is in Washington these days compared to any other time. It seems just the level of clownishness just keeps ratcheting up, that we can no longer count on intelligent minds coming to the forefront here and fixing the problem. And I think that may be showing up in the 1 month, the 2 month, the 3 month, saying let's just avoid this altogether. And maybe they're just dumping Treasury debt and moving into commercial paper, because it's an odd situation where you think, look, I'd rather lend my money to a corporation because I know I'm going to get it back, but I'm not too sure about the Treasury. That's an odd situation. That's the only argument I can come up with for why the 1 month would be sitting so much higher than where the target rate is. The effective federal funds rate is 5.08. This is 5.59, which is 50 basis points higher. 124 in 1 week. And again, let me stress, Thursday was 5.76. So I don't know what's going on there. You have capital market rates coming down, nothing on the 10-year, and a little bit of movement on the longer end of the curve. Look at the shape of the yield curve. It's completely inverted, except between the 10 and the 30. We look at inversions, 305 days now on the 2 to 10. That's still inverted 48 basis points. The more critical one is the 3 month to the 10-year, 182. May 4th, the Thursday, hit a record for this cycle at 189. In 79.80, this inversion was over 200 basis points. I think it got to 260 basis points at its worst. And we're heading for the 200 mark on the inversion here. If we look at the 3-month rate 18 months from now minus the current 3-month rate, inverted 220 basis points. That's another record for this cycle. Versus 204 previously. Now, when you say it's a record for this cycle, you're comparing different rates. You're comparing an unsecured rate previously with a secured rate now. So maybe it's not such a fair comparison. But 220 basis points inversion is the deepest in this cycle. Look at the Fed balance sheet. It continues to run off. The SOMA is off by $43.5 billion. U.S. Treasuries down by $40.5 billion, and $3 billion off in floating rate notes, sitting at $7.69 trillion, under $7.7 trillion. This is just the securities that were held particularly for quantitative easing. The balance sheet itself is $8.5 billion, down from $8.562, a drop of $58.8 billion. $43 billion from the SOMA leaves $15.5 billion from its own side of the balance sheet, not counting the SOMA. Money market funds, retail up $26.5 billion, institution $20.7 billion. Money market funds increased by $47.15 billion to $5.3 trillion for the week ended Wednesday, May the 3rd. And, I think I've heard some commentary on this, and I think that it is probably more important now than ever, is if we look back to 2006, rates were sitting at 5.25%. Money market funds were a viable alternative for anybody. But, it's amazing what 17 years can do, because we're sitting in 2023. 17 years later, the speed of communication, the speed of transmission is so much faster now that everyone is more aware that they have an alternative. Even though that same alternative existed 17 years ago, there was no informational transmission at the speed we have today to let everyone know that, hey, listen, if you got money sitting there, you can do better by moving it over here. Yes, that alternative existed then, but many people were unaware until you tap them on the shoulder and you say, hey, do you know that you can do this? Then they suddenly become aware. And one survey, I forget the pollster that did it, asked people, do you feel comfortable with your money in the bank? And a significant percentage of them said, no, I do not. So the idea that what Powell said is FRC draws a line under this and deposit outflows have stabilized, I don't know about that, because you're becoming more and more aware that you can do better somewhere else. For example, I have balances in a corporate account at TD Bank. Business accounts pay no interest at all, but they're significant balances. Moving them to Interactive Brokers, I get 4.33% right away. And it takes 24 hours. I just send a request and the money's there in 24 hours. To get it back, I send a request before 9:30 in the morning and it's back in 24 hours. So I can move it that quickly. Why would I not do it? Why would other people not do it? Why would they not be aware? So this idea that it's done, I have a hard time accepting that. If a lot of people are concerned about leaving their money in the bank in the U.S., and you can do better in money market funds, and you have this speed of transmission, and not only the speed of transmission, but it's being talked about everywhere. Every news outlet that you go to is talking about this issue. I think citizens are hyper aware that this is a possibility, and each and every day money is flowing out of deposits into these funds. I mean, come on, when you're doing it at a rate of $50 billion a week, $200 billion a month leaving, it's got to be leaving somewhere, right? I find that to say FRC draws a line under this and that outflows have stabilized, I don't think those are true statements. All right, a bit of an empty screen here. I didn't have anything else to fill the spot, so I thought, well, okay, nothing to fill the spot. The next FOMC, June 14, 38 days away. CPI for the month of April is in 3 days. Very next day we get PPI, and 8 days from now we get the Senior Loan Officer Opinion Survey. That is out at 2 p.m. on May 8th, next Monday. There are 2 Fed speakers that I could find this week. I know there are more. I just couldn't find the calendar, but I know there are more. Waller on May 11th at 10:15 a.m. You can watch that live. There's a link on the FOMC site, not the FOMC, the Fed site, because Waller's a governor. There's a link there to watch it live. Jefferson on Friday, 7:45 p.m. June 14th, here's the odds. 25 basis point hike. There is still some weight on that, 8.5%. Last week was 23.9. And on no hike, this week 91.5, last week was 76.1, which isn't quite true because this is split between 0 and negative 25. So I just collapsed it all into the 0 category. So it is predominantly betting that there is no rate hike next week. When we look at the Fed funds futures curve, the market seems to be pricing in a higher rate cut by December. But when I get there, I'll explain why I don't think the market is thinking the Fed is cutting rates, that it's something else. For December 13th, we're no longer looking at June 14th as a terminal. Let's go right to the end of the month now, December 13th. This is last week, and this is this week over here. So this week it was ranging from 4.25 to 5.25, which is where we are. Nothing on higher. Last week there was a 0.3% at 5.5 and a 0.9 at 4. It's tightened up in the range. The weight of it seems to be on the 4.5, 50%, with almost equal amounts on either side of it. We're at 5.25 because this is the high point of the range that I put down. So this 4 is actually 3.75 to 4, but I just put the high end of the range down. So we're at 5.25 now. So the weight of it is either 50, anywhere from 50 to 100 basis points lower by December 13th. As the economy remains resilient, because I think at this point your recession is going to be some significant event. I think outflows from the banking sector could be significant enough to do something. It could break something somewhere. I don't know. That's the whole thing about something breaking, is conditions are right for something to be broken, but what breaks it is the random event. But we know these random events happen. We know they do. It's just you don't know when and you don't know where, but you know they happen. So I think that the market, all of this is reflecting some belief that given enough time, some random event is going to happen, and that's what that is. Effective federal funds rate is now at 5.08. Reverse repo is down 118 billion for the month, April 28th to May 5th. But if you look at the operations, end of month always increases, end of month always increases, end of month always increases. This is an end of month. This is the first week after. I don't think that that is a trend other than just a reversal of what happened at the end of the month. That's now paying 5.05%. Okay, real rates. Inversion is gone. There is no inversion anymore. 116 to 117 to 118 to 137 to 152. That is an upward sloping real yield curve. Looking at break-even rates, all of them have increased as well. Lower real rates are supportive of higher equity prices because you're discounting real cash flows, which are easier to project by a lower real rate. Look at the Fed funds futures. It is now bottoming out in June at 94.93 for 5.07, which is right where we are, right in the middle of that range. Last week we were bottoming out in July at 94.89 for 5.11, down 4 basis points, and this is consistent with where the effective federal funds rate is now, which is 5.08. Heading out to December. Last week we had 95.375 for an implied rate of 4.625. We're 95.58 at 4.42 on the rate, which is a drop of 20.5 basis points. From June at 94.93 to 95.58, there's a drop of 65 basis points in the rate, 5.07 to 4.42. Last week it was, I think, 50 basis points or 49 basis points. Now it's a drop of 65. Going out to March, 96.015 for a rate of 3.985. Last week was 4.23. So my thinking is, if you get no event from week to week, all of these are going to have to start coming down. This curve will do this kind of thing over time. You will see it flatten out until you get an event. Then you're going to get something that looks like this dramatically, depending on the significance of the event. And I think that that curve right now, when we say 65 basis points drop between now and December, I do not think that's the market saying Fed's going to cut rates 50 basis points. I don't think anyone at this point believes that the Fed's simply just going to cut rates because inflation is going down. I don't think anyone believes that. I think this is just a weighted average of those who say, yes, there is going to be an event, and I'm going to position myself right now, because if the Fed is on hold, well, my downside isn't that bad. If I'm long the Fed funds futures, the downside isn't too bad. And if an event happens, the upside is going to be great. December 24 minus December 23 using 1 month SOFR, 287 and 428 is inverted 141 basis points, implying that, okay, 65 by the end of the year, followed by another 141 next year, that by the time we get to December of 2024, we'll be down some 200 basis points from where we are now, which is 3.25%. And I've got the last number of weeks here in terms of where the inversion happened to be. Let's look at TLT. TLT had kind of a volatile week, which is nice. Look at the implied volatility percentile for the last 13 weeks at the 31 percentile versus 3 the week before. Down 0.35 on the week. Down only 0.35. SPY down 0.68. I've made no changes to my TLT position. I am looking to add March 24 105 calls, but I want them under $7, and I haven't seen them head under $7 at this point. If I can pick them up for $6.85, $6.90, I'd like to get them under $7. I think I'll have a chance to get them, so I just need to be patient. But I'm short the 104 puts, and if we draw a line under 104, I mean, just briefly here it got under 104, but quickly recovered, pretty much stayed over 104. These expire in May 19th, 2 weeks. So I've got 2 weeks, and if we're over 104, well, I get all of that, and I'll move out to June, and I will do it again. Okay, OAS. Now this is interesting. Look at all these increases in the spread. This is a double B is the top end of high yield, 17% expansion from 285 to 333, an increase of 48 basis points. On high yield as a group, an increase of 47 basis points. Triple C, an increase of 34. They are increasing, which I think is a reflection of more of a recession fear than anything else. Not that anything has shown up yet, but the market does anticipate future issues. So if credit is tighter and harder to get, well, then that's going to start showing up in spreads, because there might be some inability of some corporations and some companies to roll over their debt. We know high yield issues shorter term debt than investment grade, so high yield is where we would see it first. And those are based on what we've seen over the last couple of months, even through when SVB and everything was hitting the headlines. These things, the OAS, were like, nothing to see here. We're not that interested in this story. This is the biggest move I've seen in a while, even though it's still quite low. We look at high yield, still sitting at 4.95%, is still quite low. Right around 500 is considered, well, yeah, that's pretty much where it should be. So we look at this, go, yeah, it's pretty much where it should be. Still, 47 basis points in 1 week. Corporate bond issuance from January to April, 545 billion. That's down 17% year over year. Here is April. We have the April numbers, but some of the other categories don't have April yet. I tried finding it for MBS and for Treasuries, and I could find nothing updated for April. Investment grade, 72.6 billion. High yield, 19.2 billion. And based on the first week of May, high yield issuance is greater than last May already. I think it's at like 8 billion or 9 billion for the first week of May. So high yield issuance beats, for the first week this year, beats all of May for last year. And IG in the first week is around 30 billion, with Facebook being a large chunk of that 30 billion. So there was last May was 100 billion. We're sitting at just under 40 billion issuance in the very first week of May already. Look at some yields. High grade 1 to 3 year is 5.01. That is down 23 basis points from last week. 1 year Treasury at 4.73, so 28 basis points more. The 2 years at 3.92 and the 3 years at 3.63. So taking a weighted average of these, just an equal weighted average, 91.6 basis points, trying to get the 1 to 3 year Treasury comparable with the 1 to 3 year high grade. I know I should do it based on weighting of market value, but I just don't have that data. So I'll just assume there's an equal weighting. 91.6 basis points versus 106 basis points last week. Okay, mortgage rate 6.39%, down 4 basis points Thursday over Thursday. This is as of May 4th. So comparing the 10-year Treasury over the same period, down 16 basis points versus down 4. That is a spread widening of 12 basis points. Looking at mortgage REITs, agency down 4.15%, and I added 90 contracts, I should say 90 synthetics, which is a combination of 180 contracts, but 90 synthetics for January 24 with a $10 strike, which is equivalent to having exposure to 9,000 shares. So I have 90 of them. Got them over 2 days. I got some on Tuesday and some on Thursday. Average was 157 credit because the dividend is... if you do a synthetic, you get the present value of the continuously compounded dividend in the price. So you get all of your dividends today. So you turn your dividend into a capital gain and you eliminate the foreign currency exposure. Anley down 4.17. I didn't do anything there. ABR up 3.98%, coming off a week where it was up 10%. I bought 14,400 shares over the Thursday. It was under $11, so I started adding. Bought 14.4. And I opened up for January 24, 1250 synthetics. I think I got 110 of them. 165 credit. And ABR ended Friday at 1180. So that is down 70 cents from the strike price for January, but my credit was 165, so I did very well on the Friday on both the native position that I have and the synthetics. Friday morning, they had earnings. I did this on Thursday. I'm never concerned with ABR at all. They beat on revenues, they beat on earnings, they raised their dividend, and they had reduced their share count. They spent 37 million of the 50 million authorized and bought back shares at an average of 17% discount to book value per share, which only accrues to shareholder value if you can buy back your shares at a discount to what the book value is. That just adds to shareholder value. So it was basically a win right across the board. Increased their dividend from 40 cents a quarter to 42 cents, so that's $1.60 to $1.68 for the year. Great, happy with that. Home builders kind of mixed. DHI down 1.26, Lennar up 0.56, KB Homes was up, Toll Brothers was down just a bit, Pulte, call it flat, Hovnanian up 1.52, and the XHB kind of flat as well. I've started selling 30 Delta puts, DHI, Lennar, and XHB. It started looking like it during the week that, maybe these will be put to me, and then Friday, nope, no, I don't think these will be put to me. Mortgage applications for the week ending April 28 down 1.2%. Refis up 0.8. Purchase down 2%. MBS issuance. I checked before I put this screen up. I just checked SIFMA again to see if there was anything updated, and they had April. So great. I added this to the chart. Issuance January to April, 354.2 billion. That is down 65% year over year. So we are seeing the hit from higher rates, most definitely in this category. And for the month of April, commercial mortgage-backed securities issued 1.5 billion residential mortgage backed. These are non-conforming, 1.1. Collateralized mortgage obligations, 10.9 billion, and conforming mortgages, agency MBS, up 68.5 billion. Just to give you an idea, here is April this year, here is April last year, just sitting around 220 billion, and here we're sitting somewhere under 80 billion, 68, 78, yeah, about 80 billion. Big drop. Interesting moves in currencies this week. Canadian being really impressive. This is all week over week. The US is the first of each of the pairs, so a negative sign is the US weaker. Down 1.25 against the Canadian, down 1.27 against the peso, and down 1% against the yen. On the Canadian, I am slightly overhedged, which is a good thing, but not as overhedged as I would have liked to have been. I was waiting for 136.50, 137. Never got to 137. I got to 136.50 where I added some, but never got weaker than that. You can see the 136.50 line up here, right across there. Well, it's not drawn out as straight as I'd like it to be, but it just never got over that amount. And then Tiff Macklem started talking really hawkish, and the Canadian on Friday alone, I think, was 163 pips, which is a big move in one day. I also sold the June 74 puts to get to this number. This is at if you take 1 divided by 0.74, you'll get 1.3. The form that it is here, US CAD. You have to invert it to get to the contract price for the Canadian futures. I sold June 74 puts at 920 basis points, and as of Friday's close, they were running between 230 and 260 basis points, mostly because of what happened on Friday. So those paid off quite significantly, but I have no desire to close them. The peso, 17.76. That is a record strength. I shouldn't say record strength, but if you look back over the last 2, 3, 4 years, that is a multi-year high on the peso. And the yen still struggling here, 134.78, under 135, but well away from the 130, sub 130 where it was a couple of months ago. Well, it's down to 127, 128. I think it'll have trouble there until the BOJ signals that yield curve control is coming to an end, which everyone is anticipating it will. I think even they're anticipating it will, but until it's said, that's where we're going to stay. Gold up 2.53% on the week. Copper down 5%. Steel down 13.34%. This is saying recession for sure. Bitcoin barely moving. Don't know why this still exists, but I guess you could argue that, look, criminal enterprises exist, so anything that supports criminal enterprises will exist, and that's what Bitcoin is doing. So if you think that criminals are going to be using Bitcoin more and more, well, then Bitcoin is probably a buy. It's not a buy because you think Bitcoin is a new form of currency. It's a buy if you think that criminal activity is going to increase and drift more towards using this currency, because it is for illegal activity. Then yes, if you want to go long illegal activity and money laundering, Bitcoin is for you. Bank of Canada will raise rates further if inflation gets stuck above 2%. So they are signaling that they are willing to raise rates further, of which the Fed basically said the same thing, but is not getting the same respect as the Bank of Canada is getting at this point. Okay, let's look at the jobs report from Friday. Household survey, labor force shrunk by 43,000. Participation rate held steady at 62.6. So even though there are more employed people, your participation rate didn't increase because the labor force shrank. Employed increased by 139. Unemployed dropped by 182. Unemployment rate now sitting at 3.4%. If we look at where those numbers come from, less than high school lost 167,000. Their unemployment rate is 5.4%. At least high school, but less than college, 99,000 gain. They're sitting at 3.9% unemployment. College or less than college lost 227, 2.9% unemployment, and BA or higher up 480, sitting at 1.9. If you have ever wondered if there is a benefit to having higher education, look at these unemployment rates. Less than high school, 5.4. If you finish high school, you're in a category that has 3.9% unemployment. If you got some college, it drops to 2.9, and if you are a university graduate, 1.9%. So not only do you get paid more if you have more education, you also have more stable employment over your life with fewer periods of unemployment. So the return to education is still there. The 16 to 19 age range added 4,000. 20 to 24s dropped 53. The 25 plus added 80. Full-time 161. Part-time dropped 84. So this is really, if you look at the mix here, BA plus 480,000. Older cadre as well, 25 plus and full-time. They tend to get paid more. So when we look at average hourly earnings, up month over month, 0.48193, annualized, that's 6%. That seems like it comes in hot, 6%, but you would be expected to pay more for higher education, for older workers, and for full-time workers. Part-time workers dropped off, they get paid less. The 20 to 24 dropped off, they get paid less. The less than high school drops off, they get paid less. So just the mix changing can work its way into average hourly earnings. It's a very noisy number, and for something like this month, I would look at it and say, wow. I mean, I would expect average hourly earnings to go up just because of the mix. I don't know that you can pull apart anything from there and say, well, is that wage inflation? Now, the ECI says there's wage inflation, and the Atlanta Fed wage tracker has not updated yet for this report, because this report only landed on Friday, so they haven't updated their site for this report yet. So next week we'll look at what Atlanta wage growth tracker says for April. If we look at average weekly earnings, 0.4816, up 0.4816. So it's that speaks to aggregate incomes, and the amount of consumer spending that you can have in the economy, that is growing. Because you can have a situation where you do have average hourly earnings increase, but the number of hours worked per week keeps dropping, such that the aggregate income at the national level is either flat or dropping. Well, that's not positive for consumer spending growth. So 0.4816 comes in around the same 6% annualized. You give them more money, they will spend more money in the malls. Look at the diffusion index for employment, total private and manufacturing. Private still expanding the total. If you just look at manufacturing, still in contraction below 50. The establishment survey said 253 jobs were created. Every category increased employment except temporary services were down 23.3. But along with this release at 253 came downward adjustments to previous months. So something like 160-some thousand, 170-some thousand jobs were revised downwards. So if you net that out against the 253, the incremental gain over the last couple of months, if we say, okay, well, those other numbers did happen, then this one here is significantly lower. Job openings are now at 9.59 million. That is a drop of almost 4% week over week in the job openings. The quits rate is now at 3.85 million. That's a drop of 3.24% week over week. So you have openings now under 10 million. It was over 10 million for an extended period of time. And you have quits now under 4 million, which it was over 4 million for an extended period of time. But we've seen this before. Quits have dropped below 4 million and then just jumped right above 4 million again. And As far as the JOLTS opening, I don't know if it's dropped below 10 million and then jumped up again, but we have seen the quits rate do that. So let's see what happens with job openings. Overall, I don't know that there's anything you can look at in this jobs report and say, oh, well, hang on a second. When you look under the hood, it's rather weak. I think the only thing that you can come to is, sure, you got an annualized 6% increase in average hourly earnings, but come on, I mean, you are going to pay more for full-time workers over part-time. You're going to pay more for higher education than lower education, and you're going to pay more for older workers than you would for younger workers. So this, to me, would be consistent with that number, 6%. I wouldn't say, oh, wage inflation is back. I would say, well, it's the mix. The ECI really is the key metric. We get inflation in 3 days. You get CPI in 3 days for the month of April. Let's see what happens there. Initial claims for the week ending April 8th all the way to 29th, 240, 246, 229, 242. And with all of that, still produced 253,000 jobs. So I think this is sort of the range that we can look at, right around the 240 to 250K range. If over the month of May, initial claims are hanging out around that level, you can expect that May will probably produce positive job growth as well. Okay, let's get to the market. Forward 4-quarter earnings, 223.72. I'll show you where on the spreadsheet you can get that shortly after we're done this screen, because you have to look in 4 different cells to get to this amount, because we're using Q2, 3, and 4 from 2023 and Q1 from 2024. Was 223.28 last week, so you had a slight increase in the estimate, and SPX closing is down week over week. Not much, but down. 406.1 gives us 18.15 times the forward earnings. I've been saying that if you look at the long-term average for forward earnings, it's 16.6. Somebody sent me a link on LinkedIn to JP Morgan, some JP Morgan research, and in there they note the long-term, the 20-year average, sorry, 16.8. So we're very, very close on 16.6 and 16.8. It'd put you somewhere down here in terms of an equilibrium price. Equilibrium just means that you sometimes you have valuations that are above equilibrium, sometimes below, but that it is sort of an attractor point in terms of the multiple that you're willing to pay. It's a long-term average, which is an attractor point. So the way you use that is you just assess the environment you're in and you say, does this justify an above average multiple? And above average multiples usually come at bottom of contractions, where central banks have lowered rates, unemployment is very high, capacity utilization is low, so that there's a lot of potential in the economy to be filled in before inflationary pressures show up. But when central banks have rates elevated and are not cutting rates but suggesting that rates are going to go higher, Bank of Canada said they might, ECB says they will, the Fed is on hold but saying, well, we'll go higher if we have to. When credit is contracting and earnings estimates, on a broad basis, month over month are coming down, that is not the condition for an above equilibrium multiple. Hence my short beta position. The inverse of the PE, 5.5, the 10-year sitting at 344, so there's 206 basis points on a risk premium from moving out of the 10-year into the S&P. There is some volatility coming back in. The percentile is sitting at 9% on the last 13 weeks versus 0 the week before. It was higher on the Thursday. And then Friday's rally took it all away. During the week, I sold June 41.70 puts, the July 41.70s, and the September 41.50s only because they have $50 differences, 41.50, 4,200. There is no 41.70 for September. These all have the September underlying. I am short the $4,000 call with the September underlying for June. Average premium of 170 on that. Average premium here of 119, 120, somewhere in that range. I was picking them up. Being that this is a 4170 put, this is a 4,000 call with a 170 premium. My break even is 4170 here. The 120 adds to that, gives me a break even now of 4290, and we're sitting at 4061. Do we have 43 or 23? 230 points to the upside. That'd be 5% rally from here. If we look at where we were before Jackson Hole, that would get us to 4,300. I have heard some forecasts of this rally lasting to 4,300. I seem to think that we're going to have trouble at 4,200 because it's been quite some time that we've had an issue there. However, you have had a series of higher lows, so technically speaking, it looks constructive for a breakout above 4150, 4160. How far it goes, I don't know, but I took that opportunity to raise my break even, and I lowered the amount of short beta I have by selling some puts at 4170, 4150. Depending on the rally we get, what gets us there, and how far we go, I will sell July and August 4,200 calls. I haven't made that a sort of a rule at this point, saying I'm about to do that. I'm going to wait to see what the market does, and if it continues to rally, I think I'll sell some of those calls. Here's some things I did during the week as well. I added 12,000 shares to my GM position under 33 bucks. I also sold 110 June $35 puts, credit of 345. They have a, if you look at the 1 year chart, 42 down to 32, 42 down to 32. They have this kind of cycle. They really aren't going anywhere. But give me a stock that looks like that with implied volatility in the mid-30s. I think they're 36%. Show me something like that that's going nowhere, that tends to go sideways in a large enough range that has that volatility, and I'll show you an income factory. And that's exactly what GM has been for the last little while, is a nice little income factory. You buy it at the lower end of the range, sell it at the higher end of the range. So I used the June 35 puts. I didn't want to use 32 or 31 puts because as GM was rising, I wanted to participate in the upside to a point. So I got options with deltas greater than 0.5. I also sold puts on Alcoa, on Oxy, BHP, TD, and BNS. BNS 66 strike, TD was an 80 strike. BHP I think was a 57.50 strike. Same with Oxy. This is all for June, 57.50. And Alcoa I think was a 35 or 33 strike. Off the top of my head, I can't quite remember now. On the weekend, Warren Buffett said at the Berkshire meeting that they have no plans to take over Oxy. That's not their motivation. They can buy up to 50% of the shares. I think they own a little over 20% right now, but no plans to take it out. So I don't know how that is going to result in Oxy opening on Monday. They report earnings next week, so some risk event there for Oxy, or two risk events at least. What's the reaction going to be to Berkshire saying no, we're not going to take it out, and then earnings? However, the other side of my brain says, well, wait a minute here. If he was going to take it out, the last thing he would tell everyone is that he's going to take it out, because it would push the price up and cost him more. So if he did have any intentions of buying it, the last thing he would admit to is that he has intentions to buying it. Office and retail for REITs, they're under pressure. I think they'll be under pressure for a while. And in most of the REIT space, cap rates are too low for the current level of where the risk-free rate is. So I added to my IYR $80 synthetic short. And how I get to that conclusion is just by adding up premiums. If we look at cap rates, that is R minus G. But the R is not the risk-free rate. It's the cost of equity, or the expected cost of equity for real estate. When we look at REITs, the capital structure for most REITs sitting around, on average, about 50% debt. Some are as high as 70% debt in their capital structure. So if you have a risk-free rate that's sitting at 5.25%, you then have to determine how much debt it has, and let's say that it's got 50%, at the lower end, or at the average end, 50% debt. What's the premium for real estate debt over the cost of the risk-free rate? You can say, well, maybe it's investment grade, and you might want to give it a spread of 151 basis points, because that's where investment grade is. I think it's closer to high yield. I think that especially in commercial real estate, it's probably more around 400 basis points, and that would be at the lower end of that would be like a double B spread. So if you gave it for its debt, you're still just at debt. You still have to have some premium over debt to get to equity. And let's say you're comfortable just giving it 200 basis points on that. You're at 11.25 for the cost of equity. I'm seeing some cap rates that are still down around 4%. So to get around 4%, you're telling me you have a G of 7.25%. When I can look across a number of REITs that are reporting and looking at their NOI growth, sub 3%, especially on apartments, you got sub 3%. These numbers just aren't adding up for me. Now, the higher the level of debt, the higher this number would have to be. If you're pushing up to 60 or 70% debt, you might have to go to 500 or 600 basis points. And are you comfortable with 200 basis points when you have this level of debt? You might have to go a little higher. I think the average in the S&P is 30%. I think the average debt level is 30%. So REITs already have a higher debt load than the average in the S&P. So 200 might be low. You might be as high as 13% on the cost of equity. So even to get down to a 5% cap rate, you got to sell me on a growth rate of 8% on net operating income. Unheard of. You have growth rates under 3%, 2.8, 2.9%. I just don't know why this isn't falling apart at this point in time, unless there's a belief that, well, the Fed is going to cut rates and that the risk-free rate is simply too high and it should be something more around 2.25%. And maybe we don't like the 4. Maybe we should be giving an investment grade at 1.55% and we're comfortable at 2%. There you can get to it, but that to me at this point in time seems like fantasy. So I expect office and retail to continue to underperform, and for everything else, the cap rate is simply just too low when I consider where the risk-free rate is, when I consider what the debt equity ratio of the average REIT is compared to the debt equity ratio of the average S&P. The S&P is mostly investment grade companies. Well, I shouldn't say mostly, it's all investment grade companies. I don't know that all these REITs are investment grade. So their spread is going to be higher, and equity is the bottom of the capital stack. Are you comfortable with just a 200 basis point premium, or do you want more? Once you add that all up and you imply the growth rate you need to get to the cap rate, it just doesn't make any sense at all. So I added to that $80 synthetic short. Okay, so on the first page of the spreadsheet, if you look under column C and you look for rows 127 through to 130, notice that this is estimates 6/30/23. This is the end of the second quarter. So there's Q2 of 23, there's Q3, Q4, and you add Q1 of 2024. So the sum of these four are your forward earnings forecast, because we are in Q1 right now. Okay, so for the week, this is what is reporting. Kind of a mix. There's only 31 that are reporting. There's Occidental down there. I'll let you, if you have the spreadsheet, you can go through these. The big retailers aren't reporting till next week. You have Home Depot, Target, TJX, Walmart. So you get those two big ones next week. That's it for earnings. Let's look at the economic calendar. Okay, as far as the economic calendar is concerned, Monday, Tuesday, pretty much empty. Wednesday, 8:30, CPI. Thursday, 8:30, PPI. And Friday at 10, you got consumer sentiment. And you don't have many earnings reports this week at all. We ended Friday very strong. We don't have much, almost nothing on Monday and Tuesday, nothing till Wednesday. So I find that weeks like this where you don't have a lot of data points and you have we left off with a certain sentiment, have more risk in the market than if you had more data points and you had more earnings. Because whatever narrative we open with on Monday will simply just gain steam. I mean, you can open Monday with, hey, it was a good jobs report. The economy is doing okay. The consumer's going to be fine. By the close of Monday day, the Fed's going to be cutting rates. They're going to pivot. We have the strongest economy we've had in 2,000 years, and everything is going to be wonderful. These narratives have a way of feeding on themselves, that every hour, even though nothing changes, the optimism grows and grows and grows, and the short covering happens, and the market moves up, and the fear of missing out sets in, and money just has got to get into this market, and we forget about everything. Everything is on hold because the narrative rules the day. And if you don't have enough data points coming out to say, hey, hang on a second, let's anchor ourselves to reality. Let's look around. Yes, we do have a good jobs market, but we have other problems as well. When there's a lack of those data points pulling that narrative back to reality, it can create a momentum that, if you're short, is a huge risk event. So for me going into this week, the big risk event, being that I am short at the level of the market, is not CPI. It is what narrative is going to rule the day Monday and Tuesday, because that could take us to ridiculous places. You could add 100 points on Monday and Tuesday alone, just out of the narrative gaining its own steam. And every time the story makes the circuit, the story adds another element of optimism every single time. That's the bigger risk event that I'm worried about, is Monday and Tuesday. You get inflation on Wednesday, and if it comes in lighter than expected, it will only fuel that narrative even more, and 4,300 could be in play by the end of Friday, of which I would then be prepared to roll up my short puts and do some work on. But if it comes in sideways, it may not be enough to overcome whatever narrative we have going on. So that means if you got a Monday and Tuesday driven by a narrative that everything's going to be great, it's never been a better time, equities are ridiculously underpriced, because I have heard that statement, ridiculously underpriced, not just fairly valued or undervalued, ridiculously underpriced. I thought, okay, somebody's got a long book. But that narrative could get a hold, and if you get that and you get inflation that goes sideways, you could get a market that just is so full of optimism it just looks past that and continues to rally on that. So equity markets right now, I'd say the bias on Monday opening is to the upside. It feels like the bias is to the upside because nothing has happened this weekend that would negate what happened on Friday. And Berkshire had great earnings on the weekend, reported good growth, and he was upbeat about the U.S. economy, but he's always upbeat about the U.S. economy. Never bet against the U.S. economy, he says. So right now the bias is to the upside. And it's a matter of, how far do we go? And if CPI on Wednesday confirms that story, then 4,300 is in play, which could cause me some pain into the end of the week, but there we are. As far as yields are concerned, I'm less certain about where it can go, because the bond market doesn't seem to, I think, have the same level of ability to look past everything that the equity market does. I mean, I've heard some analysts say we're looking past all of this to 2024. We're looking past all of this. Well, how can you look past an event that may actually hurt the very things that you're trying to buy? I don't understand this looking past things. You know, it's like I got to get to the mall, but in getting to the mall, I got to get through a group of people who all have guns aimed at me. Okay, well, I'm looking past the shootings. And here's what I'm going to buy when I'm at the mall. I'm looking past the gunfire. I mean, I may not make it to the mall. So this idea of looking past stuff, I think, but you're looking past the very thing that could affect what it is that you want to buy. Wouldn't you want to at least consider that? Anyways, I guess my point is, being that there is almost nothing going on, you do, if you have any short positions, the bias right now seems to be to the upside. This seems to be the biggest risk event right now, is that there is nothing to derail that narrative from gaining its own steam and gaining its own momentum. So play accordingly. It is better to preserve your capital and give up any future profit that you thought you might make with your position than it is to bury your head in the sand and say, I'm not paying attention anymore. So if you are short and the market is going to move against you, use those puts. Try to rebalance your beta back to something that's a little more satisfying for you and doesn't hurt you on the way up. And it's okay to give up any future profit potential in the name of preserving your capital. And for Monday and Tuesday, that's what I'll be watching to see if I need to sell more puts. And we'll see what happens on Wednesday. But again, it depends on how we open. And it depends on what the story of the day is and what the story on going into Tuesday is. Because look, there's nothing to derail it. There is nothing to derail it unless you get some kind of external event somewhere. Anyways, that's it for the week.